Jerome Powell came out today and said that fighting inflation may include heading into a recession. And that's really scary. And so that's what we're going to dive into in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into it. You can see here that Federal Chair Jerome Powell says that higher interest rates could cause a recession. However, it is essential that we bring inflation down. Well, at least that's what he told Congress, but that's not what the street wants to hear. But of course, over the long term, if inflation runs away from any of us and it goes into hyperinflation, we all suffer anyway. So I think he's on the right track here. And so he went on to say here that the central bank's battle against inflation could lead it to raise interest rates high enough to cause an economic downturn. But he did go on to say that although it's a possibility, they're not trying to provoke and do not think that they will need to provoke a recession. But we do think that it's absolutely essential to bring down inflation. Now, here's the thing. I think the way that they operate is they tiptoe into these things. And so the fact that they've even started to use the word recession, where before they were using the word soft landing, tells you a lot more than it doesn't tell you. And so it's something to be aware of. I'm already starting to see companies announce cuts, layoffs, etc. You guys have been seeing it, especially in the tech space. So let's just see how this continues. But it's a tall task to suggest that they can tame inflation without taking us into a recession. So it's something that I think we've all sort of been expecting. And so that's why you're seeing the consumer discretionary stocks get hammered. You're also seeing the housing stocks get hammered. And so I think the market really is expecting a downturn, but we'll see how this sort of plays out. And you can see here in the article that the Federal Reserve's new projections released last week show that all 18 of the Fed officials expect to raise the federal funds rate to at least 3% this year, with most seeing it rising to a range of between 3.25 and 3.5 by December. And that's huge considering that it's currently in a range of between 1.5 and 1.75. And you can see at the bottom of this article here that the Mortgage Bankers Association reported Wednesday that the average 30-year fixed mortgage rose to approximately 6% last week from 5.65% the prior week. Now, a lot of people will argue that we are in historically low rate periods, and even 3 to 3.5% is very low. And you'll see that here. Yes, we are very low relative to historical rates. However, I would argue that there's more risk in the system right now. There's a lot of people with homes that, although they're sitting on equity right now, if the bubble bursts, or I'm not even saying that it's a bubble, but if home prices start to decline and those declines snowball, a lot of people could be underwater. The other thing is, as people start refinancing, for those people who are on adjustable rate mortgages, they're going to have to adjust at higher rates. Now, that's not a huge part of the market anyways, or what is a bigger consideration for this market is the people who are getting newer mortgages. Those mortgages are going to be much more expensive, those monthly payments, unless home prices come down. And I, for one, have predicted on this channel that home prices are not just going to come down, they're going to tumble down. But we have seen with May's home price numbers that home prices have actually gone even higher, which was a surprise to me. I thought they would start coming down in May, but I do believe that they're definitely going to start coming down in June or July. Don't hold me to that, but I do believe that there's only one direction that home prices are going to go as rates continue to go up. And the other area where we're starting to see this risk manifest of higher rates and a slowing economy is with earnings rate revisions. And so FactSet actually puts out a very good article, and I really recommend that you guys try to get this article every quarter. So you can see here there are downward revisions that are now more common. So in the FactSet article that they put out in June, in terms of earnings estimate revisions for companies in the S&P 500, analysts have decreased earnings estimates in aggregate for Q2 of 2022. So in other words, analysts have been revising earnings estimates downwards. But what are the companies doing? Well, obviously they're doing the same. So going back, you can see more S&P 500 companies have issued negative EPS guidance for Q2 compared to the recent quarters as well. At this point in time, 103 companies in the index have issued EPS guidance for Q2, and of these 103 companies, more than 70%, so 72 have issued negative EPS guidance. So that's huge. It's really showing a negative bias to earnings estimates and earnings revisions, and thus downward pressure on share prices. So you can see that for Q2, it looks like utilities, consumer discretionaries, industrials and materials, and real estate have had the most earnings negative revisions than the S&P 500 as a whole. Now, I'm pretty much on board with most of those. Utilities kind of caught me up by surprise because I thought utilities were generally geared towards inflation and commodity costs, but I might be wrong there. You guys let me know in the comments sort of which utilities I might be talking about. They might be talking about midstreamers, and I could see that midstreamers get impacted here. They might even be talking about refiners, but I think that refiners are making more profits right now. So I don't know what part of the utility space is negative, and I just might not be thinking about it deeply enough right now. But let me know in the comments which utilities would be revising their earnings estimates significantly downwards. And what does this look like for fiscal year 2022? So you can see that the same culprits are there. So communication services, utilities, financials, consumer discretionaries, and the industrials. Those are what you would expect. Well, I would expect all of those except for maybe utilities. I'm still not sure why the utilities are there. But obviously, you can see, especially of the companies that we follow, great brands, but they're the consumer discretionary segment. You can see that 70% of the revisions are negative, which is a huge negative sentiment to the industry as a whole, which is why we're seeing the names in our consumer discretionary space of the stocks that we track on the Patreon tracker, share prices continue to go further and further lower. And you can see that really well in this next graph too. So you can see that this is the S&P 500 12-month PE ratio going back 10 years. And so you can see here that the 12-month forward PE ratio is 15.8 times earnings as of June 15th. That's less than their 5-year average of 18.6 times earnings and less than their 10-year average of 16.9 times earnings. Now, I do want to say, over a historical time period, a very long time period, the backwards looking EPS is around 15 times. So when we see an EPS of the S&P 500 at approximately 15.8 times earnings, it's still a little bit overvalued. I'd say almost maybe like fairly valued. But if we're heading into a recession, do we want to be a little bit overvalued? Or do you think that that forward looking EPS would turn down even more because there's more pessimism built into the market? So effectively what I'm suggesting is that I think that this can go under 15, even 14 times future earnings, but we'll see what happens. And the other bigger risk is what happens if those earnings continue to get revised downwards overall for the market. So right now it's saying, or it's looking like it's 15.8 times earnings, but if those earnings get revised downwards, it might actually be reflecting 18, 19 times earnings, and so it has to come down even more. So we don't know, or it may not even come down, it may just stay there. We don't know how this is going to play out, but I think that there's more downward pressure than upward pressure. Now, I'm not a market timer. I'll buy my companies where I see them. In fact, I'll dollar cost average great brands over a long-term time horizon. However, it's very interesting to know that we have a very downward biased market right now. And you can see that these are the 11 companies that are in the tracker that are trading under 50% of their intrinsic value. So you can see that that's actually a bit of a record if you've been following this channel so far. Usually we sit around 5 or 6 names. Recently we got up to 7 names, and now all of a sudden, boom, it's up to 11 names because you can see there's 4 or 5 names that just came in, just snuck in. You know, they're 48%, 45% of their intrinsic value. 2 names that you guys are very familiar with if you watch this channel is Alibaba and Zillow Group. So it's interesting to see that more and more names are coming into the tracker. And the other interesting thing is there's now 4 names that are cheaper from a price to intrinsic value perspective than Alibaba. And that's something interesting because before, early on, Alibaba was the cheapest one on the tracker. And now there's 4 names that are even cheaper than Alibaba. So that's very interesting to see. And we'll see how that continues to evolve. And of course, like I always say, you guys can get access to the tracker at the lower tier for the Patreons. And of course, you guys know that I believe so much in the product that if you do decide to try it out, and you decide that it's not for you, don't just unsubscribe. Let me know in the Patreon app by messaging me and telling me that you tried it and it wasn't for you, and I'll fully refund your first month subscription because that's how much I believe in the product. Now, one scary thing that I do want you guys to pay attention to, and this is worse than the risk of delisting, is the potential risk that you might not be allowed to invest in Chinese stocks from a bipartisan-led group of US legislators. And I actually break that down in this video right here.